Hello, everybody, and welcome back to our second quarter market review for 2025. This quarter packed a punch. From tariff changes and events almost daily, a clash between the president and, well, the president of the Federal Reserve, and then an amazing relief rally in stocks on top of it. There's certainly quite a lot to get into. So let's break it down and talk about where we go from here in the markets. What we saw in the second quarter was nothing short of a comeback story. The Nasdaq led the pack, fueled by tech stocks, right? That growth component, continued AI optimism around the world, and a reversion of the value over growth trade, which we saw in the first quarter, with growth actually outperforming by a wider margin this time. The S&P 500 followed closely behind the Nasdaq as tariff uncertainty almost vanished overnight. This gave much needed clarity to investors in many sectors and allowed the S&P to move higher. And then finally, the Dow Jones, one of the oldest indexes in the world, did underperform slightly, again being weighed down by more of that industrial and material heavy areas of the Dow Jones components. Those are going to be more sensitive to tariff news and continued uncertainty on the political front. But overall, right, a tremendous 3 month stretch for U.S. stocks. Hopefully, we can carry this momentum into the second half of the year as we see things continue to change. And you always have to remember this, right? Markets are a living, breathing entity that react almost instantaneously to changes in the news, right? We saw a very quick and steep sell off after Trump's now famous tariff tantrum market crash when he had the press conference in the Rose Garden. Stocks quickly lost close to 20% in a matter of days, right? Complete destruction of value very quickly. But what we saw is then the president announced that tariffs would be paused until later in the year. Stocks rebounded sharply, and we got that beautiful V-shaped recovery that you see circled on the screen. Now, at the end of the second quarter, we're sitting at near all-time highs for stocks. However, most people would never have believed this could have happened after the market sold off. Yet they can't come to grips with the very same thing that caused the sell-off in the first place, right? The market immediately pricing in new information. That's what the market does. And in this scenario, unlike 2021 and 2022, where stocks suffered due to inflation and rising interest rates and a lot more economic fundamental issues, this was a sell off manufactured by the president, and the remedy was always on the shelf, right? The remedy being pause tariffs, continue discussions with countries until we find something suitable for both parties. So, with this information of the tariff pauses, markets and investors felt a lot more comfortable to buy stocks and reprice themselves higher, as we saw throughout the second quarter of 2025. Turning abroad now, markets were a little more mixed. We saw Japan and Germany outperform. They had manufacturing pick up, and both of their central banks offered a lot of support. They became a lot more dovish over the second quarter compared to the U.S., which has still maintained that hawkish stand on interest rates, keeping them where they're at an elevated level. We also saw Hong Kong, otherwise China, lag due to geopolitical tensions and trade fears, primarily with the United States. But on the European front, right, Europe posted moderate gains for a second consecutive quarter, something very positive to see for investors looking for that diversification into European markets. Looking year to date, foreign markets have done very well amid U.S. equity volatility, almost surprisingly well, right? Investors have clearly been looking for places to hide outside of the United States. And quite honestly, they've done so by investing in other large developed countries. But again, this is why we don't only preach asset allocation, but optimal sub asset allocations, right? You want your equity component in your portfolio to represent the global stock market, not just the US stock market, not just Europe's stock market. You want a mix of everything in your portfolio to maximize return and minimize risk, right? That's the goal of portfolio construction. And just to give you an idea of how well foreign markets have done this year compared to the US, as you can clearly see, foreign markets have performed and outperformed domestic equities for the first half of the year. Now, this may change over the second half of the year, right? No one knows for certain, but what we do know is that If you're invested in foreign markets, as we were over the first 2 quarters of the year, your portfolio performed a lot better than being invested all domestically. Turning over to bonds, otherwise known as fixed income, looking at interest rates and the interest rate curve, right? Because interest rates are the cost of money. That's going to affect the price of bonds. What we know is that when interest rates rise, the price of bonds falls and vice versa. So if you're a bond investor, you want interest rates to be coming down in order to gain return. Bond yields, however, over the second quarter did remain elevated. The 10-year hovered around 4.5%, with the short end of the curve staying close to 5%. So it's been a tough environment for bonds, but yields may have peaked, and a lot of people believe will come down dramatically over the second half of the year. I wanted to also show this chart to give some perspective on just the amount of rate increases we've had over the last 5 years. And that's what this chart shows. So it's the same interest rate curve. However, we're looking at 2020 versus 2025, right? 5 years apart. And what we can see is 5 years ago, rates were near zero. Now they're the highest in decades. In fact, over the last 5 years, it's been one of the most aggressive pushes the Federal Reserve has ever had towards higher interest rates. That reset has hurt bond prices, but has created attractive income opportunities moving forward as investors can get larger coupons from their bonds. And if interest rates come down from this level at all, we would expect the return of bonds to be favorable. And then finally, performance across different bond segments varied based on maturity and their credit quality, right? Long term corporate bonds led the way, gaining 1% the second quarter. They're now up 3% year to date. Shorter term bonds also posted modest gains. And even with long term treasuries dropping slightly this quarter, they're still up over 2% for the year, right? So it's been a very positive year for bond investors compared to the last several years that they've seen. And I also wanted to touch on why you hold bonds in a portfolio, right? Not just for the return, not just for the income benefit, but bonds continue to serve four essential roles in any portfolio: diversification, downside risk protection, income generation, and this psychological anchoring, which helps you be a better investor by essentially seeing less volatility in your portfolio. It's a studied fact that investors who see less volatility tend to not make as drastic decisions in their portfolio, such as selling out and going all cash, right? So while bonds may not always deliver those eye popping returns as stocks can, their ability to stabilize a portfolio and provide steady income is absolutely critical, and especially when you're dealing with volatile equity markets on or uncertain economic environments as we're seeing at this moment. So, what's behind the rally? What's driving risk and return at this moment? I think it can be looked at as a mix of four dominant forces, what I would call the core four. First and foremost, it's tariffs, right? It's tariff policy, it's tariff arguments with other countries, and finally, tariff clarity. To be honest, right, when President Trump announced his sweeping tariffs on April 2nd, markets quickly panicked, realizing that we were going into a full blown trade war. About a week later, on April 8th, markets made their low for the year at this moment. But what we know is that we had a very quick pivot and V shaped recovery after the administration decided to pause tariffs, give countries a chance to respond. A lot of investors thought that was a signal of diplomacy by the Trump administration, and equities stabilized because of it. And while we may revisit tariff disputes later in the year, the second quarter has definitely proved that market sentiment is deeply positive right now. Looking at the second driver of risk and return, it has to be earnings growth and corporate strength. Earnings have remained the backbone of this rally, whether they're talked about or not. Not only have we seen very strong results from mega cap tech names, but profit margins have improved across sectors as we've seen supply chains stabilize and consumer spending remaining solid. So currently, we're projected to grow earnings in the U.S. Stock market by about 8.5% this year. And that's above average. If you look historically, you would assume roughly a 6% growth rate in earnings in any given year. So this 8.5% projection by a lot of big investment banks and research firms, this isn't just a number, right? It's a signal of corporate resilience amid a lot of things going on. So for us to have the earnings strength that we've had at this moment, I think it's a positive for the market going forward. Fed expectations and how the bond market's been behaving is definitely the third driver for risk and return in this market cycle. The Fed has undoubtedly stayed rock solid in its higher for longer stance. However, we are finally starting to see inflation data come down. It's giving the market a lot of confidence that rate cuts are coming, albeit eventually, right? The President of the United States and the President of the Federal Reserve have been essentially beefing over the last several months, and who knows what will come from that. But what we do know is that lower interest rates support an ease in credit markets. Lower interest rates increases the price and potential return on bonds, and they do support higher equity prices as companies can go out and get financing at a lot cheaper of a price as they would right now with interest rates being elevated. So interest rates and the Fed are always going to influence stock prices. It's something that happens throughout each market cycle, and it's something that will continue to happen throughout the next market cycle. So we're continuing to watch this. And then finally, that fourth driver and possibly the key component of risk and return in the market right now is the technological advances we're seeing in artificial intelligence and generative AI, right? Those are no longer just buzzwords. It's driving real investment across many different platforms, right? It's cloud infrastructure, it's chip design and manufacturing, software. It's amazing the breadth of adoption that we're seeing in areas not just in tech that are benefiting from artificial intelligence, right? You have healthcare, manufacturing, finance, agriculture. AI is infiltrating all of these areas. And so part of the reason why the market's moved higher is because it's rewarding this productivity tailwind that we're seeing currently with AI, right? And what we know is that as technological advances happen, they push societies further into economic progress and prosperity. I believe that's something that we're seeing right now and could continue to see over the next 5 to 10 years. So I do think this bull market has a lot of room to run, especially if companies and the United States and the world continue to adopt AI as we've seen over the last 2 years. I'll just wrap this up by saying that as an investor, it's so critical that you are disciplined in your investment strategy, you have perspective for market history, and you believe in innovation and the long term prospect of economic growth. Those are the foundations of long term successful investing. So, with that, please let us know if you would like to revisit your plan or talk strategy. We're always here to help. And thank you for joining us for our second quarter review.